these countries that for, as recent as a few years ago, in and of themselves would not have had the ability to stand up to the West and their manipulation and their central banks and their commercial banks and the ramifications they now in unison can. And that's why you're seeing such massive delivery and exchange for physical coming out around the globe, emanating from COMEX, where they're draining the exchanges based upon the make-believe prices. That won't end well. It's one of these deals where I've always said little by little by little by little and bang all at once. Well, the little by little has been going on for a long time. When is the all at once? Don't know, but it's coming as far as I'm concerned.
The surge in silver imports, as reported by the Economic Times of India, highlights India's significant impact on global prices. Imports soared by 260% in February to a record high of 2,295 tons, indicating a substantial increase in demand. According to Andy Schectman, India's silver purchases over the past 3 years, totaling over 500 million ounces, exceed the available supply on COMEX. This imbalance, compounded by rehypothecation challenges, blurs pricing and demand realities in the COMEX market. Consequently, there may be a rush for physical accumulation and price discovery outside COMEX influence. Furthermore, the accumulation of physical assets by countries previously unable to challenge Western manipulation signals a shifting global dynamic. Massive delivery and exchange for physical transactions are draining exchanges based on fictitious prices. This trend underscores the growing recognition of tangible assets like silver in a world where market manipulations and speculative pricing are prevalent. Andy warns that while suppression tactics may have persisted incrementally, a tipping point is imminent. The recent drop in the spot price of silver, from just over $29.60 per ounce to just under $27 before rebounding late on Friday, underscores the manipulation by shorts and price manipulators in the paper market. The recent drop in silver prices appears to have been orchestrated by those seeking to control the market. Despite expectations of a correction due to overbuying and breaking key price levels, manipulators took advantage of the situation. While Asian demand initially supported prices, once London markets closed, a significant decline ensued on COMEX. Although silver closed above $28 for the week, the event underscores the looming market upheaval as global demand for precious metals grows and more nations challenge dollar dominance. Andy predicts a turbulent period, emphasizing the difficulty of controlling a market driven by strong demand. We will present clips from Andy Schectman's interview with Silver Slayer. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
It's harder. The only way you can manipulate a market over an extended period of time is to push it in the direction it's going. And when you have a country like India, who's purchased over 500 million ounces of silver in the last 3 years, that's, there's only 300 million ounces of silver on COMEX total, of which only roughly 40 some million are 3 million are in the registered category. Those are the bars that are available for delivery, backing the contracts, which have been rehypothecated 1,800%, meaning 18 people are sold the same contract. Only one would get it if they stood for delivery. And so it is a situation where, the COMEX market is being, it's blurring the reality. It's blurring the reality of the price and of the demand. And I think you could see a period of time where, there's a rush to accumulate physical. There's a rush to find price discovery. And this could very quickly overwhelm the COMEX. It could very quickly overwhelm the shorts that are on COMEX. And very quickly you could see what real price discovery looks like, where supply and demand find equilibrium, where it isn't being distorted by the leverage on COMEX. And it seems like we're getting to that point quickly, much faster, because these countries that for, as recent as a few years ago, in and of themselves would not have had the ability to stand up to the West and their manipulation and their central banks and their commercial banks and the ramifications they now in unison can. And that's why you're seeing such massive delivery and exchange for physical coming out around the globe, emanating from COMEX, where they're draining the exchanges based upon the make-believe prices. That won't end well. It's one of these deals where I've always said little by little by little by little and bang all at once. Well, the little by little has been going on for a long time. When is the all at once? Don't know, but it's coming as far as I'm concerned. Why would they be short, and why are they trying to hold it down? Well, it is the military industrial complex. That will end very badly if the rest of the world understands that and starts to challenge them for what it is. And I think that's what India is doing. I think they understand that. So, this is something that I think will only get worse. It will only get more acute, and it will be very violent when it moves up, in the respect that you can't control a market where the demand is as big as it truly is. Most of the time that I've been doing this over the last 3+ decades, the global demand for gold and silver has been muted, but now it's insatiable and growing, as is the de-dollarization and the de-treasurization that we're seeing alongside of it. And this is a bad recipe for the shorts on COMEX looking to hold prices down. I think it ends poorly.
One of the most significant shifts in global finance has been the gradual resurgence of gold as a key player in the monetary system. Central banks have been quietly increasing their gold reserves in recent years, driven by geopolitical tensions and a growing lack of confidence in traditional currencies. This renewed interest in gold has been further accelerated by events like the freezing of Russian foreign exchange reserves, highlighting gold's enduring appeal in uncertain times. Andy asserts that in response, some central banks are considering leveraging their gold reserves, potentially revaluing gold to reflect its true market worth better. This idea of revaluing gold, possibly to $5,000 or even $10,000 per ounce, has gained traction among economists and financial experts like Andy Schectman. Such a move could offer much-needed stability to central bank balance sheets in an increasingly volatile economic environment. Furthermore, tangible assets like gold and oil are increasingly recognized as alternative currencies. Nations increasingly turn to gold to settle international transactions, particularly in energy markets. This trend suggests a broader remonetization of gold on a global scale, marking a significant shift in the financial landscape.
If you revalue your gold, and if you go and look at all the central bank balance sheets, look at one of the central bank balance sheets, you'll see gold is held in an account called the gold revaluation account. That's the name of the account on every central bank balance sheet. Ironic, isn't it? The head of the Dutch National Bank said we should revalue the price of gold. That's what Roosevelt did behind me. He confiscated gold because it was money back then. Everyone owned it, paid everyone $20.56 per ounce when it was at $20 an ounce. 56 cents in 1933 was a lot of money. A dozen eggs were probably a nickel. And so they thought, oh, that's a good deal. But then he devalued the dollar and gold went up by 40% to $35 an ounce. So, they can revalue the price of gold, which on every balance sheet in Europe is held at $35 an ounce still. So they could revalue it to $5,000, $10,000 an ounce. This is why people say gold will be revalued. What it would immediately offset the balance sheet, their liabilities would immediately be offset by gold at a way higher price. And I think that is a possibility. To me, I think you see gold revalued before you see countries understanding what we are transitioning into a new period where gold will be essential. Because right now it seems to me that gold is being used, gold and oil in particular, are being used as money. They're being remonetized across the globe. I really do believe that, man. And I think that when you look at the way that the world is accumulating gold right now and using it in a fashion to, in essence, pay for oil and gas and other commodities first in their own currencies, and then those currencies are recycled into gold reserves instead of treasuries. I think you'll see gold prices go much higher. I think that they will revalue the price of gold on their balance sheets. I don't know if the IMF does it. I don't know if the BRICS do it, but I think you will see that because I think gold and oil is becoming a currency or re-becoming a currency. So to sell it, no. But I think to revalue it would be a higher probability. First of all, supposedly the ETFs are backed by a commensurate amount of silver that each share, it's called a proxy, where each share is representative of an amount of silver in the vault. during silver squeeze, there was such great demand for the ETFs that the custodian, JP Morgan and BlackRock, published an addendum to the prospectus that said there may be more demand. Because of demand, there may be more shares than there are silver bars backing it. The folks that have the ability to redeem a basket, which you're talking, I don't know, 20, $30 million worth or more, have the ability to, if it's allowed, because sometimes they will disallow redemptions, but you're talking the commercial banks that have the ability to redeem the gold and silver. The rest of us don't. If you own GLD and SLV, and even if you have several $1 million worth, you're not getting the metal out of it. It's a cash representation. And so if you look at how the ETFs have been going down in American participation, meaning the what's inside the ETFs have been falling, it means people have been selling into the rally and buying crypto and Bitcoin and Nvidia as the price keeps going higher. And that is a massive contrarian indicator. So, in this case, you could argue it has been happening. People have been selling. And at the same time, you have positive real yields, if you believe the Bureau of Labor Statistics, which I don't, but let's just call it as it is. Positive real yields, a strong dollar, and the American public asleep at the switch and, in fact, selling into the rally. Look at the ETF numbers. You'll see that. And yet the price keeps going higher because the central banks and the big money who know the playbook are front running all of this. By the time the public wakes up and jumps on board, the easy pickings, the low lying fruit will be long gone. And, what is very flush and available right now can very quickly change when you see a mass hysteria, people realizing they need to do something. And in large part, the American public has not taken part in much of any of this rally at all. In fact, the statistics would bear that out.
The silver market is likely to see significant upheaval. As more investors and nations prioritize physical silver over paper assets, the demand for actual silver will skyrocket. This shift could cause silver prices to surge, reflecting true market value rather than manipulated prices. The imbalance in the market may lead to a rush for physical silver, driving prices even higher and making it harder for price manipulators to maintain control. As a result, precious metals like silver and gold may become increasingly vital as stable, tangible assets in a volatile global economy. How will the surge in demand for physical silver reshape the global market and challenge existing price manipulations? Share your thoughts in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.